So far, our models have used squared shocks, which means they ignore the sign of the news. A positive surprise and a negative surprise of the same size push next period's variance up by exactly the same amount, but equity data often tell a different story. A drop tends to raise future volatility more than an equally large rise. We call this an asymmetric volatility response, and it is often linked to leverage, changing financial risk, investor behavior, and market frictions. The economic story should be used carefully. A falling equity value can raise a firm's debt-to-equity ratio and make its equity riskier, which is the traditional leverage explanation. Market stress, constrained trading, and rapid reassessment of downside risk can also amplify negative news. The empirical fact is an unequal conditional variance response. A volatility model identifies that response from data, but it does not by itself prove which economic mechanism caused it. Exponential GARCH, or EGARCH, models the logarithm of conditional variance. The log variance depends on its own lag, the signed standardized shock, and the magnitude of that standardized shock. Taking the logarithm guarantees a positive variance without imposing non-negative coefficients on every term. The signed component creates asymmetry. When its coefficient is negative under the usual convention, a negative standardized shock raises log variance more than a positive shock of the same size. The magnitude term in EGARCH captures the general effect of surprising news, regardless of sign. The signed term tilts that response toward good or bad news. Because shocks are standardized by their conditional standard deviation, the model judges news relative to the risk that was expected at the time. A raw return of 2% can be enormous in a quiet market, but ordinary in a crisis. Standardization lets the model distinguish those situations. The GJR-GARCH model adds an indicator for negative lagged shocks to the ordinary variance recursion. Today's variance includes the usual intercept, lagged variance and squared shock, plus an extra squared shock effect when yesterday's shock was negative. A positive extra coefficient means bad news has the larger impact. Unlike EGARCH, this model works directly with variance, so parameter restrictions must still ensure that the fitted variance remains non-negative and that relevant moments exist. A news impact curve summarizes the fitted relationship between yesterday's shock and today's variance while holding lagged variance fixed. Standard GARCH produces a symmetric curve around 0. An asymmetric model produces different branches for positive and negative shocks. The curve is a useful communication device because it reveals both curvature and direction. However, it is a conditional model summary, not a causal graph. Its shape depends on the specification and the chosen reference variance. Threshold models offer related ways to separate regimes created by shock signs. A threshold GARCH model can assign different squared shock coefficients to negative and non-negative innovations. A threshold ARCH model may describe conditional standard deviation using absolute shocks with different slopes on the two sides of 0. These models are easy to interpret, but a hard indicator creates an abrupt boundary. If the actual response changes smoothly, a threshold specification may exaggerate the discontinuity. Some volatility changes are broader than the sign of one shock.